decided not to come here with a very extensive presentation. Actually, in fact, I presented one slide, and it's just going to be this one. The reason for that is not because we're very lazy at blockchain. Let me be very clear. We're actually a very active team, and we're building hard to bring real-world assets on-chain. But the reason why I decided not to make a presentation today is because of the fact that we have noticed that the adoption of the Web3 technology is mainly driven by an understanding of a community that is not stemming from the Web3 movement. The adoption of Web3, the adoption of virtual asset, and all of the very technical presentations that we have here today, which are absolutely great, will only find its way if the bigger crowds start to understand the actual benefit of the technology that we are building. I'm the co-founder of PropChain, and in PropChain we have built a Web3 ecosystem that is focused on PropTech and real-world assets. The reason why we have chosen to focus on the real estate industry is because there's a whole lot of stuff that needs improvement there. We see fraud, we see inefficiency, we see human error, we see a lot happening in real estate that can be, yeah, we have a bit of a problem there. This one is better? No, it's not working. Now it's working, perfect. In real estate we see a whole lot of illiquidity problems, we see a lot of limitations these days, we see people struggling with primary home ownership, we see people struggling of getting access to a landscape that is traditionally known as one of the most safest asset classes globally for the last hundreds, maybe thousands of years. In today's masterclass, I want to get you all into a deeper understanding of what tokenization actually means. And I would like to hear from you. What is your current understanding of RWA? Who can tell me something about it? I'm very interested to hear more about what the current level of knowledge is within this space. Anyone? Who knows RWA? Who knows tokenization? What is your understanding? What is it? That says a lot.
You said something?
Yes.
A digital version of a real asset.
A digital version of a real asset. That's the RWA side. What do we know about tokenization, guys? What is the current understanding of tokenization?
It opens the door to fractional sharing.
Correct. You name a very important term, fractional. Because there's a whole lot of confusion these days between tokenization and fractionalization. Essentially, in the majority of the cases, these things go hand in hand, right? The current understanding that we have and the preaches that everyone is making when it comes to fractionalization and tokenization in more particular is that they're preaching about liquidity, for example. Traditional illiquid assets like real estate, like art, like collectibles, cars, watches, you name it, they could be more liquid if they became tradable, right? They could become more liquid if they were put in a fractional form, in a digital token, and you can start swapping these things around with each other. It's a perfect narrative. It's a very big promise as well, because it's not that black and white as that people are currently preaching these days, and we see that. We see that happening in the tokenization landscape, we see it happening in the RWA landscape. There's a whole lot of screaming going on, but not too many projects are actually delivering on that promise. How many projects do you see these days that actually provide you with real-world assets that then become tradable on a secondary market in a liquid manner? I can tell you, it is hardly anyone. Why is that? What particular problem are we facing in today's movement of RWA, tokenization, and fractionalization? Let's start at the basics. Fractionalization is a concept that we know. We know this for the last 20, 30 years already. There's a whole lot of these models going on. We have crowdfunding, we have in real estate, for example, real estate investment trusts. We have a whole lot of movements that have been distributing a certain way of fractionalization across, giving you a fraction of an asset, giving you access to a fraction of an asset. So that narrative is not new. Tokenization, so making it digital, making it tradable, that's what is renewing. So this part is mainly existent out of a couple of layers, and I think that a lot of people need to get a better understanding of what it means in real estate. Because it is not that black and white as going out there, buying a real estate property, then making 1,000 owners register at the land department. And over the fact that here in Dubai, we're actually in a very progressive area where the land department, for example, is actually brought on chain and has the vision to double their economy by the means of tokenization. On a global basis, we still do not see much of a change when it comes to, for example, land registries. In the current land registry, the majority of the cases, you will have only 3 to 4 people allowed on a title deed of a property. So that brings a core issue. The core issue that you can fractionalize and that you can tokenize, but it's not as flourishing as everybody tends to preach, because there are only 4 people that can own it. That is not that level of accessibility that you would like to achieve. So we always work with a layered approach when we start tokenizing. The first layer is always the asset layer. What is the asset that you're looking to tokenize in the real world? It can be a real estate asset, it can be a watch, it can be a car. We have seen several examples. The second layer is the ownership layer. How do we own this asset if we want to bring the asset on chain? Who is the legal owner of that particular asset in the real world today? In real estate, as already mentioned, we have the problem with the land department, so we need an SPV. Generally, a corporate vehicle that is having the special purpose of holding the ownership of that particular asset. With that being said, that brings us to the next challenge, because as soon as you start selling fractions of an SPV, you start dealing with regulatory bodies globally. And this is one of the core issues that we face currently in creating global adoption of tokenized assets. Why? We do not have a global standardized framework that is recognizing tokenized securities, tokenized shares of an SPV holding an asset as one and the same thing. What we face these days is that in Europe, the shares of that SPV holding the assets can be recognized as an alternative investment fund. Whilst in Dubai, they may be just seen as the shares of a holding vehicle and doesn't fall under any regulations. That brings huge difficulties when you're trying to create a globally adopted standard for trading and creating liquidity in the secondary market. Again, primary issuance can be done by anyone. Anyone can go out there, put an asset in an SPV, fractionalize it, tokenize it, if you do some research, and you can offer it. But then having that asset trade and find its way through multiple owners, that's where the complicated stuff starts. So 3 is always the regulatory layer. How are you going to make sure the offering that you're doing in a primary market, but also in a secondary market, is going to be regulatory compliant? Above that, above the regulatory layer, we have the investor layer. Actually, we have the technology layer, is what I would like to call it. Because next to the fact that we now have a share and it's regulatory compliant, we need to package it in a token so it becomes issuable. And it also becomes tradable later. So the tech layer is what we have built as the tokenization factory. We have created an infrastructure where we are basically able to compliantly issue security tokens on a global scale with a fully automized backend that is doing investment due diligence, has the regulatory boundaries, so for example the investment limits per country, the investors that are accepted, which jurisdictions are blocked for example, and to what hands can this particular token, this particular fraction actually trade. Because in the secondary market, we do not necessarily control the investors that went in the primary issuance. So you need the secondary checks, the regulatory checks on a constant basis. We have created an automated system for that based on smart contracts that is checking that all automatically. The last bit is actually your investor layer. And this is a big problem that we have in tokenization as well. Because for who is tokenization and fractionalization more specifically the most interesting? It's for the people normally with the lower budgets, right? You want to create lower entry barriers into real estate, into art, into cars, into collectibles, whatever. Instead of buying a Van Gogh, you can now fractionalize it and you can invest for 500 euros. But that means that you're tapping in a retail investor pool. And generally speaking, retail investors is one of the biggest hassles to deal with all around the globe, without insulting anyone. But it's the most protected investor base. And that again brings us back to the regulatory problems that we're facing there. You can actually issue to retail investors, but you're very limited. And you do not have the ability to issue in the same manner in Dubai as you would be in Europe, and also not to the US, and also not to Asia. So these are the layers that you generally work with when it comes to asset tokenization. And the fact that we see so many platforms and so many companies go out there now and talk about this in a very simplified manner is actually quite interesting. At the same time, it's quite concerning, and at the same time, it's also giving a great opportunity for people that know what they're doing. So this is the layered approach, and this is a layered approach that you should always verify when you get in touch with a project that is claiming to tokenize real-world assets. Maybe the regulatory layer is what keeps you from winning here. So what do we do? What do we do at PropChain? Why have we focused particularly on the real estate market? First of all, I believe that, as I mentioned already in my introduction, the real estate market is one of the most static markets that we know. It is the hardest when it comes to innovation, when it comes to change, but also when it comes to accessibility today. In many regions globally, or pretty much in any region globally, we have seen extreme surge in real estate prices. We have seen extreme surge in rent, especially here in Dubai. I'm pretty sure that everybody that lives here has faced some of the increasing rents over the past year, right? So there are quite a bit of primary problems to solve when it comes to real estate, and that's one of the reasons why we have chosen specifically to focus on that market. Next to the fact that we have a pretty significant background in real estate development and real estate trade, which we do on a global basis. So, what problems are there to solve in real estate? That was a question that we were asking ourselves 3 years ago, nearly. And the primary problem which we faced back then was the fact that we saw that there was a huge amount of money packed in the retail investment crowd that wanted to be in real estate but couldn't be in real estate. Great, we thought. Let's build something awesome with what we just heard, the tokenization technology, the fractionalization. And through that process, whilst we were building the application of a fractionalized investment platform where we could then list our own real estate, which was kind of a two-bird, one-stone approach, we actually noticed that we were not really solving a core problem. We're not solving a real problem, right? Okay, you don't have access to the real estate market to invest in. That's not the end of the world, I would say. So we were realizing that we were actually solving a secondary problem, but also creating a huge opportunity. The primary problem that we saw and that we noticed over time was the fact that people deal with an extremely difficult process of gaining primary home ownership. That was mainly here in Dubai, for example. How many people tried to buy a house here but didn't manage to do so? Because, for example, as an expat, the credit score wasn't sufficient, or the prices were simply too high. We're not able to save up for that down payment of the mortgage, or whatsoever. And we've seen it in many regions globally. We've also seen it in the Netherlands, we've seen it in Singapore, which is also a great example of a very blown up real estate market. But the problem that we noticed there was that there should be a way to solve primary home ownership prior to getting these people to invest in fractionalized real estate. And we started to look at how can we apply our technology when it comes to primary home ownership and the stakeholders that are involved in that process, which is a bank providing a mortgage, which is a credit bureau logging the credit of someone, the credit worthiness of someone, which is essentially driving your likelihood to be accepted for a mortgage. And at the same time, erasing that big hurdle that they were facing every month, their rental payouts, for example, their rental payments. So what we built is an ecosystem, or at least a sub-ecosystem of our primary ecosystem, where we are enhancing home ownership, where we have basically dealt with three core stakeholders. The investor, basically the landlord, facilitating properties for people to live in, for people to rent. The credit bureau, or at least what we have built as an on-chain credit score. And three, the actual eventual bank providing you with the mortgage. And we have created a rent-to-own model, where people can come to us they can receive the necessary funding to buy the house that they were previously looking to rent. And during a period of 3 to 4 to 5 years, depending on the person's income, we reserve a portion of that particular rent payment that they're doing every month in an on-chain wallet, which can be verified by external parties, including the stakeholders like the bank, to save up for their future down payment 3, 4, 5 years from now. At the same time, log in their credit worthiness by registering their payments on chain. Essentially creating an automated cycle where people become eligible at a certain point by their credit score, by their saved up down payments, to have a fully facilitated mortgage. So essentially driving primary home ownership. Why is this so important? Economies like Dubai thrive on tourism, have been thriving a lot on tourism, and they are looking to bring their rental nature of the market down. There's currently 85%, 80 to 85% of the residents here is renting their primary home. They want to bring this down to around 50% in the next 6 years, 7 years. So these concepts are heavily supported by governments, and then you're actually solving a primary problem. Other solution, other vertical that taps right in there, and that's something that I hear all the time: liquidity, liquidity, liquidity. We can now start selling and trading assets with each other. Yeah, right. Find the buyer. Who wants to buy this token that I bought somewhere 3 years ago, right? What is needed there? What is the core problem when you want to make something that is illiquid, liquid? Who has some suggestions? What is the core problem when you're trying to sell an asset that was previously illiquid?
Annual yield.
It's one part, definitely. But what is it at the time?
What's the question?
What is the core problem that you face when you're trying to sell a tokenized asset, a previously illiquid asset, now in the secondary market?
In my opinion, I suppose just the main problem today is just no basic regulation and just legal package for this tokenization and for the ownage of this token. That's the main problem.
That's definitely one of those, but not necessarily for the secondary market.
For secondary market is just the simple rules of the game, just for understanding the unique liquidity for home tokens, just should be interconnected with each other, just to have the common currency, just for understanding of the people. It will increase the liquidity.
It comes very close. It comes very close. There's some more hands.
Demand.
Demand, for sure.
Yeah, of course, demand. Of course, it's the basic.
That's the basics.
But
I miss a core element.
There is a quick request, there is a huge request for the tokenization of real estate in this market in Dubai.
Yeah.
The only one problem is just the legal package.
The core problem is pricing.
Pricing and
Pricing is the core problem.
business models as well. not only
Business
pricing.
models as well, but they are being created all across. So pricing is pretty much the primary problem that we face when we're talking about liquidity of tokenized assets. How many times do you evaluate your house? Like anybody that owns a house here? No? All renting? Great, we're part of our movement.
The majority are renting it.
Yeah. Anyway, normally portfolios, real estate portfolios get evaluated once a year. I mean, if I look at our real estate portfolio and the real estate that we develop, we evaluate it maybe once a year. So what happens when I start trading an illiquid asset that gets evaluated once a year, now once a week or once a day?
You will have a discount.
You will have a discount or you will have inefficient pricing. And the latter is really dangerous when you start.
As every real estate trust on other exchanges, you will have the same.
Definitely, you have the problem. But it becomes bigger when it's individual assets.
Plus, you will have discount for the tokenization. So why you need tokens if you have real estate trust?
Because it's not so much about packaging real estate. It's about being able to globally diversify, which a real estate investment trust doesn't do. They are fully focused on an area, which is, in my opinion, not the most beneficial case.
Oh, globalization.
You can
Yes, I know.
You can have fund of funds, and you will have global diversification if you need.
Yeah, and then you're paying what fees? And what is the secondary market for that?
But you will have less discount.
Of course, luckily. It's mainly about the pricing element that makes tokenization dangerous, not necessarily in real estate only. This happens in every form of illiquid asset. The problem is that when you start trading an illiquid asset, which is not valuated at today's rate, you will get a lot of inefficiency in the pricing of the market.
Also, one of the core problems, that's not the problems, but one of the core achievements and tasks, you need to have the inner cycle of the money inside the system. Just
Yeah.
don't to see the cash out just because they had to turn on inside. That's
Exactly. So it's all about what is that asset worth today? If you want to take part of that liquidity, if you want to utilize that liquidity. And I think that is one of the main reasons why today, in all of the tokenization concepts that we see, and in all of the markets that are being created, and all of those little items that we see established at today's rate, we have the main problem in facilitating a secondary market where assets are priced fairly. And that's what we're solving with AI, partially. We're building pricing algorithms that base their predictions on multiple hundreds of data points from a particular market to get a more accurate pricing for an asset today. And that's something that we will need in the market if we want to create an ever-increasing liquidity when it comes to tokenized assets. And that's also one of the reasons why we see the bigger players, JP Morgan, the leading banks that are currently applying tokenization technology, not necessarily create new products. What they are doing is that they are optimizing flow, creating some internal liquidity, but nothing new. No new liquidity windows, not new secondary markets or whatsoever. The technology is currently being used mainly for process optimization. And that's something that we're trying to change. And that's also the reason why today I didn't decide to go as technical as possible. Because today's market, the only way we will see Web3 and digital assets, real world assets, move on chain is by creating a landscape which is built in a hybrid manner, where a Web2 crowd or the regular crowd can utilize Web3 based applications without having to know anything about it. And that's how we build. We build products based on the ecosystem, based on the technology that I've just presented to you, but when you look at our front ends, you will not have any idea that you're utilizing a Web3 based product. And that's how we can drive mass adoption of Web3, by creating understanding, because change comes with understanding, change comes by usage, and I believe that that is the way that we like to follow when it comes to presenting our products to the market. And that was my presentation, guys, about real-world assets, where we are standing today, and how we foresee the landscape evolve. Thank you.